you're paying 2% annually, that's actually a lot less than paying, 10% annually is a lot less than paying 2% weekly.
Great.
All right. Income tax rate's the same, sales tax rate. I've changed the days inventory assumption here, but you could make it whatever you want. Useful life of our equipment. You remember it used to be 10 weeks. We're going to make this new equipment worth 5 years. And then an annual growth rate of 10%. Before we had weekly growth rates, now we have an annual growth rate.
So why are those numbers blue and the rest black?
Well, these numbers are so we can change them if we want to. We might think, well, we thought our useful life was going to be 5 years, but it turns out it's longer, like 10.
Oh, so then I can just play with it and see what it does.
Uh-huh.
Awesome.
Yeah, we can play with it now, in fact. I'll do a quick play. So we're going to assume year 0. These are actual numbers. And we've got an income statement, revenue, cost of goods sold, gross profit. Those should be familiar with you. Our expenses, marketing, R&D, depreciation, miscellaneous, also familiar. And an operating profit. We're not going to cover how to get to those things. Those are done in a previous tutorial. But I do want to show you something interesting here. When I'm building a forecast like this for 5 years, I'll calculate this percentage. This is my cost of goods sold as a percentage of sales. It's 35%. And then I can use that same cost of goods sold, and I'll show you how. I just go equals cost of goods sold times revenue. Oh, that just did a little bit of a rounding, but otherwise it's the same, right? So, I'm going to let you go ahead, build your 5-year forecast, get yourself all set up with a balanced balance sheet and all those things you need so that you have an income statement and a balance sheet for 5 years. And then we're going to come back and show you how to put a value on your company. Sound good?
Sounds great.
All right. We'll see you in a few. Hi, I'm Brother Crawford.
And I'm Alex.
Welcome back. I'm Brother Crawford.
And I'm Alex's teacher's assistant.
And we're getting on with the valuation here. So one of the things I want to do differently is now you'll notice I have these percentages in between the year 0 and year 1. Year 0 is really just our actual results in the most recent reporting period. Or in this case, we're going to use the forecasted results that you created because you don't have a full year of operations yet. But these percentages, I wanted to keep them in here so you can see where they are. Like we spent 8% of our budget on our revenues on marketing, 5% on R&D. And to forecast forward, we can just assume we're going to keep those percentages the same, and that's how it goes. But to do the valuation, I thought it'd be important for us to reorder these so that each of the financials is sequential in the spreadsheet. So go ahead and do that, and then you can pause the video, and then when you're done, unpause it, and we'll be right here.
Sounds good.
Okay. Are you done yet? Okay, good. Let's keep moving forward. So, in order to do a discounted cash flow model, we need to understand what the cash flow is. All right? Cash flow starts with operating income. So let's just type that in. Operating income. All right? Now, you should know that there are a lot of different ways to value a company. Sometimes you'll use a multiple of the revenues, sometimes a multiple of the profits, or multiple of operating, EBIT multiple. You're going to hear lots of different ways. We're going to use what's called discounted cash flows, and even here, you're going to see kind of a basic introduction to that. This is not, by any means, a sophisticated way to do it, but it'll help you understand the time value of money and also a little bit better about how your cash flow works. So we'll start with EBIT. Alex, why don't you just go ahead and show us the EBIT off of our current income statement. We can just copy that down or make sure we show it up here.
So we already figured out EBIT up here. It starts here, and this is the EBIT for each year. So we just want to do equals. We'll just scroll up and get the EBIT.
Yep.
Just do that, enter, and then you just drag it across. And how you do that is you wait for that little black arrow.
A little black arrow on the green
Or
square.
a plus sign, actually, yeah. And you just drag it across.
That's sounds great. So that's our operating income. Cash flow begins with operating income. So we'll let you get to that stage of this tutorial, and we'll see you in the next segment. Welcome back to this tutorial on how to value your IBC company. I'm Brother Crawford.
And I'm Alex, his teacher's assistant.
And let's go through the formula, Alex, for how to get to cash flow. So cash flow begins with operating income.
Okay.
But then we need to add back any non-cash expenditures.
Okay.
And then we subtract changes in working capital, and we subtract any capital expenditures we have. So let's do that. We'll just go plus, and guess what? Non-cash expenditures in this case would be, or expenses would be depreciation. It's the only thing we have in here. So we'll add back depreciation, less change in working capital, did I spell it wrong? Change in,
And then
that's not right. I'm going to fix it.
we can make a word.
Change in working capital, and then less capital expenditures. Capital expenditures are like property, plant, equipment, things that we're going to buy that we would depreciate over time. Expenditures. Because if you'll remember,
Because that won't show up in the income statement.
That's right.
Because we don't expense the whole entire thing of depreciation.
that's right, the capital expenditures, they don't show up. They only show up in the form of depreciation. But if I spend $10,000 on a piece of equipment, that cash went out of my business, even though the asset still sits on the books.
Okay.
All right?
Okay.
That's how that goes.
Hmm.
All right, so
So,
let's go ahead and we'll just add in depreciation. So we'll just, Alex, just take us and just put in the depreciation line there, and that'll be a good place to pause this next one.
Okay. So since we've already calculated depreciation in our income statement, we're just going to do equals. We're going to find the depreciation expense here, and then we're just going to click enter and do the same thing. Just drag it over.
Oh yeah, I noticed something here. Notice that we're doing the cash flow for year 0. That's actually, since it's in the past, it doesn't count, right? So this first year we can delete those two.
Oh,
Yeah, we're not going to use those. All right, good. We'll use it a little bit here, but go ahead and get yourself down to where you've got your EBIT and then your depreciation, the line for depreciation in there, and then once you're done with that, we'll see you in the next segment. Thanks. Welcome back to this segment on valuation. I'm Brother Crawford,
and I'm Alex, his TA.
and now we're going to show you the change in working capital. Working capital is just the current assets of a business minus the current liabilities. So let's give it a shot here. And the change in working capital, I should say, is, so the working capital is current assets minus current liabilities. And then that's some amount. And let's just figure out what it is right now. So current assets is going to be, we're going to start with year 1, and it's going to be account receivables plus inventory.
Why don't I include cash? Because isn't that a current asset?
Cash is a current asset. But we're looking at this, we're trying to figure out how much cash flow the business is generating. And when we made this forecast, we assumed that the cash would sit in the cash account.
So if I zero this out, then we only have cash.
You might need a little bit of cash, but this business isn't going to need $44,000, or we're looking year 5, $151,000 in cash. It doesn't need that much, right?
Okay.
So we're just going to assume that we don't really need any cash for day to day, because that's such a small number, and we don't want to complicate things for you. So we're leaving cash out of our current assets, but that's a good catch, Alex. All right. And then we go minus our current liabilities. So let's add up the current liabilities. That would be accounts payable, interest payable, and note payable.
Oh, we need to do the sum.
notices that we have a note payable but no interest payable, right? We're assuming in this model that we're going to pay off this interest every year. So it's not that we don't have an interest expense. You'll know that from our income statement we do have an interest expense, but we're going to pay it off. So we used cash to pay off the interest. So that reduces our cash flow.
Okay.
All right? So this is the first step in changing our working capital. This is the working capital at the end of year one. But to calculate the change, we need to actually find out the working capital from year two, or from year zero. Yeah. Because that working capital change is going to be whatever this working capital is. And our working capital, remember, is just our current assets minus our current liabilities. And so that's the first working capital. And whatever this is, it changed from the previous year, so we have to subtract the previous year from that. And that gives us the change in working capital. That's probably the hardest thing you're going to do in this video series right here. So I'm going to go ahead and we'll come down to the formula. We'll hit enter, cross our fingers. Our working capital changed by $88. Whenever I see something like that, I go, that doesn't seem right. So then I just go back and check. Let's see, I left cash out. Cash changed by quite a bit, like $20,000, right? But as we discussed already, that's cash that was generated that we can use to give to our investors. We can keep it as long as we have the right to it. You know, it's cash flow. So that $20,000 is really good. Let's see here.
Wait, so is it kind of accounted for like up here in our net income?
I don't think so.
No? Okay.
Maybe. Let's find out. So
our net income would increase our cash, but then we take out things from our net income that don't have to do with cash, like the depreciation.
that
Right.
working capital's not changing a whole lot. Why do you think that is? I look at it and go, well, our notes payable isn't changing at all, right? Accounts receivable is not changing. Accounts payable, interest payable. Since none of the payables are changing, the only thing that's changing is our inventory. And since we've kept a very low number of days of inventory, this working capital is not changing a whole lot with our growth. So that might not be realistic for your business, but mathematically it works out. So why don't you go ahead and calculate the change in working capital, and we'll see you for the next segment.
Sounds good.
All right. Welcome back. I'm Brother Crawford.
And I'm Alex, his TA.
And we are, Alex was a little bit, she didn't feel good about the way I explained the cash flow
Yeah, I understand.
in the last segment. So if you're totally comfortable with how we treated cash in our change in working capital, then you should skip this video. But if you'd like a little more instruction on why we don't include cash in working capital, even though it's a current asset, then keep listening, all right? So Alex, tell me what's going on that you're confused about here.
So, why don't we include cash, like, in our change in working capital?
I already explained that to you in the last video.
I don't know.
I'm just kidding. Okay, so...
I just know because you said so.
Right. So, let's put it this way. This is a little IBC type of business, right?
Yeah.
We do $58,000 in total revenue,
Okay.
right? Do we need $44,000 to run this business in cash?
So, is it not current assets minus current liabilities then?
It is.
It's current assets besides cash?
Besides cash, well, and some people will actually adjust. They'll make two different cash things, and they'll say, we need a little bit of cash to run the business. We're going to, like, whatever we do in our day-to-day cash, we think that might be $5,000 or something. And they'll create a separate line in there for that.
Would I include that?
And you would include that in your working capital.
Oh, okay. So then, I'm just pretending I need no cash at all in my working capital.
Right. And the
Okay,
reason you're doing
I got
that
it.
because this is cash that the business generates. Right?
Okay.
And the amount of cash you need on an everyday basis is so much smaller than that number.
So I'm just going to pretend it's zero.
Pretend it's
So
zero.
if it was 5,000, I would subtract 5,000 out of here, make a new line, and put 5,000 in cash here, but then I would include that 5,000
Right.
because that I need that to function to work.
Yeah.
Got it.
But
Click. I got it.
but for this, because we want the model to be simple for our students, we're just going to pretend
So we need
that
no cash.
we don't really need any cash on a daily basis.
Okay.
And all of the cash that's in this line is available to be distributed or dispersed to investors or whatever
Okay.
we want to do with it.
Okay.
Sound
Okay.
good?
Finally click now.
All right. So that's why we didn't include cash in the in the working capital. It is part of working capital, but just for these purposes, we're saying that most of that cash is available to be distributed, and therefore it's part of the cash flow. Sound
Okay.
good? All right. So we'll see you in the next segment.
In the first place.
Welcome back to this valuation video. I'm Brother Crawford,
And I'm Alex.
and we're down to the line of capital expenditures. So realize that if we spend some money on equipment, that's going to go out in the form of cash, even though it sits on our balance sheet and we depreciate it over time. We need to account for it here. So what I'm going to do now, if you look at our model here, basically we look at our total assets, PP&E. You'll notice that we have a $10,000 asset in year zero. We're going to assume that we actually bought that after our IBC company's first year. This all came in before we started this 5-year forecast period. So this is a capital expenditure.
Wouldn't my giveaway for that be that I have no accumulated depreciation?
Yeah, that's right. In fact, we're assuming that all of the stuff that you used in your previous models, it got used up and thrown away. So you don't have any depreciation and you don't have any assets to start with. We're just kind of starting fresh right here. So we needed $10,000 in equipment, and we'll just put that in here as a capital expenditure right here. So equals, and it's negative because the cash went out of the business. So even though it sits here on the balance sheet, positive, we're going to make it negative here.
Oh,
Oh.
because
We should have done that here too.
if I didn't buy that machine, I'd have $10,000 in more cash. Yeah. Okay.
We should also make this negative. So let's do that. Right, 'cause I don't know how many parentheses I need here, but let's just, it works. Well, I hope so. Those are all negative also. Okay? Now watch this. This is going to be kind of fun. So if we did more capital expenditures in the subsequent years, our asset line would go up, right? So, for example, let's say I don't want to do that right now because I've got a balanced balance sheet and I don't want to open that can of
Oh,
worms.
yeah.
But let's just say that right here I can do equals the current year's PP&E minus the previous year's PP&E, and it shows that we didn't spend any more money on capital expenditures during those years. So I think that's reasonable for this business. And now we just do cash flow, which equals the sum of all of these. And in an earlier segment, we mentioned that we're not counting any of our operating cash flows. That's because we're assuming that money's already earned, it's in the bank. This is really about forecasting for the future. So we're saying we need to spend $10,000 today in order to make all this money in the future. And that's why we put this $10,000 here. So this is part of our cash flows, and it's times 0. Now we need to go ahead and copy this year's line, because we're going to need these years to do this next segment. So I'll just paste those in there. Why don't you go ahead and get yourself to cash flow with capital expenditures, whatever you assume you're going to need in property, plant, and equipment, and then we'll see you in the next segment. Hi, welcome to this final installment of the valuation video series for IBC. I'm Brother Crawford, and I'm just going to take you through by myself, without Alex, the final steps here in the evaluation video. So when we left off, we had you down to cash flow. So in this case, we had a negative $10,000 cash flow at the start of this new forecast, and that resulted in these cash flows which we've added up here, which is great. But how do we do a net present value? Well, the net present value is the value of all of these cash flows as though they happened today. What that means is, for example, in this example, we're going to put $10,000 in today, and then a year from now, we expect to get $30,000 in cash back to us. And then 2 years from now, 33,000, and 3 years, 36, all the way up to 44,000 at the end of year 5. But what would you rather have? Would you rather have $44,000 5 years from now, or $44,000 today? Well, I hope your answer is today. And so the way we factor in that value, the fact that the money's coming in the future, is really called the net present value. So I'll put that in here, present value. How do you do that? Well, it's a simple formula, NPV, rate. What's the rate? What rate should we use? Well, we would use what I like to call our weighted average cost of capital. That would include the interest rate we pay on our debt. It would include interest that our equity investors would demand of us. I've actually added a line in my model, and you can do the same thing for our WACC. And I've made it 10%. You can make it whatever you like. But let's just use 10% now. So that gets us the rate. Then it says values 1, 2, etc. I'm going to start by including the values that come at the end of the first year of operations. Why would I do that? Well, NPV assumes that the first cash flow is going to happen at the end of the year. So even that first cash flow that we include right here is going to be discounted by the rate that I put in, which was that 10% weighted average cost of capital. But we also had to put in this $10,000. So we need to account for that somehow. Since $10,000 today is worth $10,000 today, let's just add that in. All right, let's see what this gives us. All right, well, down to the penny. Now, I don't know about you, but with all the assumptions I've made, I don't know if I can count on this being accurate down to the penny. This says that our net present value is